Imagine standing at the edge of a bustling financial district, skyscrapers glinting in the sun, and the hum of transactions permeating the air. You notice a pattern. Certain individuals, from real estate tycoons to tech moguls, glide through the chaos with confidence and control. How did they get there? What hidden strategies do they use that allow them not just to accumulate wealth, but to sustain it and make it grow, year after year? In this video, we're unveiling precisely that. The insider tips and powerful insights that millionaires and billionaires rely on to invest wisely, minimize risk, and compound their success. Whether you're a seasoned investor looking to sharpen your edge or someone curious to start the journey toward financial independence, these expert principles can give you the roadmap you've been craving. Let's venture into the world of high-level investing. Peel back the curtain of the top 1%'s playbook and discover how you too can harness these techniques to build and protect your own empire. Welcome to today's deep dive into the minds of the rich. Our focus: how the rich invest. Insider tips from millionaires and billionaires. In the next 20 minutes, we'll travel through the cornerstone principles of wealth building, from the foundational mindset that underlies every sound investment decision to the specific strategies that turn risk into opportunity. We'll explore how these elite players diversify, where they place their bets, whether that's real estate, startups, or more traditional markets, and how they leverage networks and data to stay ahead of the curve. By the end of this video, you'll understand not only what they invest in, but why they invest the way they do. So settle in, grab a notepad if you want to remember these key points, and prepare for a masterclass in building a rock-solid financial future. 1. The wealthy mindset. Let's begin by examining the very foundation of high-level investing: mindset. The richest among us approach money and opportunity differently than the average person. Rather than looking for quick wins or riding emotional market swings, they operate with a disciplined, patient outlook that sees the big picture, sometimes decades into the future. They recognize that while short-term moves can bring excitement or anxiety, true wealth is built steadily over time. This means they are comfortable riding out market dips, confident that their well-researched positions will prove profitable in the long run. They also engage in deep, continuous learning. You'll notice billionaires frequently cite reading as a core habit. Financial reports, market analyses, and business biographies all serve to broaden their perspective and refine their decision-making. This dedication to learning is crucial. In a rapidly evolving global economy, being stagnant is a surefire way to lose your edge. Moreover, they cultivate resilience, understanding that not every bet pays off. When mistakes happen, they view them as tuition for lessons learned, adjusting strategies accordingly rather than dwelling on losses or shifting blame. In other words, they see investment missteps as part of a larger narrative, one that ultimately trends upward if guided by disciplined choices and the resolve to persevere. 2. The value of long-term vision and patience. One trait consistently distinguishing the wealthy is their commitment to long-term thinking. They're less swayed by news headlines or short-term speculation, maintaining a stable approach that focuses on compounding returns. Compounding is often called the eighth wonder of the world because, given enough time, modest gains can snowball into massive fortunes. This effect, however, only works if you're patient and steady in your approach. Many new investors panic in down markets, selling off positions for fear of further losses. The affluent, meanwhile, often see these downturns as prime buying opportunities, allowing them to grab undervalued assets at prices well below their intrinsic value. While it's tempting to believe that wealth is built through dramatic, overnight wins, in reality, the most robust fortunes arise through consistent growth, reinvestment of returns, and the willingness to let those returns compound. Equally critical is their understanding that markets are cyclical. By anticipating downturns and keeping a cash reserve, these investors can pounce on opportunities when sentiment is at its lowest. By the time the broader market recovers, they've positioned themselves to profit handsomely. This capacity to wait, sometimes for years, until conditions align with their analysis is a hallmark of millionaire and billionaire investors. 3. Diversification and asset allocation. Another keystone principle of high-level investing is diversification. This can be as straightforward as not putting all your money into a single stock, or as complex as distributing capital across multiple asset classes: equities, bonds, real estate, commodities, private equity, and more. The rationale is simple. No single market or sector is immune to volatility. By spreading out your investments, you reduce the risk that any one downturn or negative event will drastically impact your entire portfolio. Moreover, the wealthy pay meticulous attention to asset allocation, deciding the proportion of capital allocated to each category based on factors like their age, market outlook, risk tolerance, and overall financial objectives. Younger, more aggressive investors might skew heavily toward high-growth equities or even riskier venture capital funds, aiming for substantial gains over a long timeline. Older or more risk-averse individuals might favor bonds, stable dividend-paying stocks, and blue-chip investments, protecting their principal while still earning modest returns. Diversification is not merely about safety, though. It can enhance returns by ensuring you capture growth from multiple sectors. When one area lags, another might soar. Over time, this balanced approach tends to outperform extreme strategies tied to only one or two asset classes. In essence, diversification is the buffer that ensures longevity in the unpredictable seas of global finance. 4. Real estate, the bedrock of many fortunes. Real estate consistently appears in the portfolios of high-net-worth individuals for good reason. It offers tangible value, potential for steady appreciation, and, perhaps most appealing, recurring cash flow. Whether through commercial complexes, luxury apartments, or strategically located single-family rentals, real estate can provide a reliable stream of income that often increases over time as rental demand climbs. Beyond cash flow, there's the advantage of leverage. Buying property with a down payment and financing the rest through a mortgage allows you to control a far more significant asset than you could if you were limited to your own cash. Wealthy investors typically use this leverage judiciously, ensuring rents cover loan repayments and expenses, while over the years, the underlying property appreciates and builds equity. Additionally, real estate often carries tax benefits, like depreciation write-offs, and can act as a hedge against inflation, since property values and rental rates often rise in tandem with the cost of living. However, this doesn't mean that real estate is without risk. Market downturns, vacancies, and management headaches can all erode returns if you're unprepared. But for the elite investor who conducts thorough market research, understands local demands, and maintains adequate cash reserves, real estate becomes a cornerstone of financial security and generational wealth building. 5. Startup and angel investing. High risk, high reward. As technology reshapes every facet of our world, another favored avenue for the affluent is investing in startups, particularly those on the cutting edge of emerging industries. This is often referred to as angel or venture investing, where wealthy individuals or specialized funds provide capital to early-stage companies with disruptive potential. The allure is straightforward. If a startup succeeds, whether it's a tech platform that revolutionizes an industry or a biomedical firm that develops a groundbreaking treatment, the returns can be exponential. We've all heard stories of early investors in companies like Facebook, Uber, or Airbnb who turned relatively small sums into life-changing fortunes. Yet it's crucial to acknowledge that this space is fraught with risk. Most startups fail, and those who invest in them must be prepared to lose their entire stake. That's why the rich typically spread their capital across multiple ventures, aiming for a few big successes that outweigh the inevitable losses. They also lean heavily on expertise or personal networks to vet opportunities. Often, they invest in founders they trust or sectors they deeply understand. If you're new to the startup world, you might explore equity crowdfunding or smaller-scale angel syndicates, but it's essential to do extensive research, study the competitive landscape, and understand the product's potential. For the wealthy, this realm of high-risk, high-reward investing is a calculated gamble that can yield massive returns when carefully executed and timed. 6. Networking and relationship capital. One aspect of elite investing that's often overlooked is the extraordinary power of networks. The top 1% frequently cite that significant opportunities, whether in real estate, private equity, or startup ventures, emerge from relationships rather than public listings. Private deals often circulate in trusted circles, where reputations, track records, and personal rapport heavily influence who gets access. If you've ever wondered why billionaires attend high-end fundraisers, conferences, or exclusive roundtables, it's not only for philanthropy or publicity. It's also about forging alliances, discovering new investment avenues, and staying ahead of trends before they go mainstream. By cultivating strong professional and social networks, the wealthy gain insights about market changes, shifts in consumer behavior, and even regulatory developments, sometimes well before the general public. This early information can be invaluable in guiding investment decisions and avoiding pitfalls. Moreover, partnerships can distribute risk. If an investor lacks expertise in a particular arena, say commercial real estate, teaming up with a specialist can offset that gap. This synergy allows both parties to benefit from each other's strengths, ensuring higher odds of a profitable outcome. Ultimately, relationship capital can be as potent as financial capital. So the rich invest time and effort in building and maintaining relationships that unlock ever more lucrative opportunities. 7. Balancing active and passive strategies. One key to sustainable wealth is knowing when to be hands-on and when to step back. Active investing might involve stock picking, flipping properties, or steering a startup's strategic decisions. It can yield impressive gains if you or your team have the requisite expertise and time. However, it also brings increased risk and the possibility of larger losses if market conditions shift unpredictably or if you make flawed judgments. On the other hand, passive strategies, like index fund investing or owning stable, cash-flowing real estate, allow you to enjoy the fruits of broad market growth with minimal day-to-day involvement. Wealthy individuals often blend both, maintaining a robust passive core to ensure steady returns and preserve capital, while reserving a portion for active endeavors that offer higher reward potential. This balanced approach acknowledges that while chasing alpha, outperformance of the market, can be exhilarating, it's also volatile. Meanwhile, the passive segment of a portfolio functions like a safety net, growing moderately but reliably over time. To implement this in your own life, determine which areas align with your skill set and passion. If you excel in analyzing tech stocks, you might allocate more active capital there, but be sure to include a diversified passive component, such as broad-based index funds or stable rental properties, so you're not entirely reliant on winning big in a single arena. 8. Risk management and downside protection. Building wealth is only half the game. The other half is keeping it. This is where risk management comes in, a skill the ultra-affluent hold in high regard. For them, it's not about avoiding all risk, because zero-risk scenarios rarely yield meaningful returns. Instead, they methodically evaluate potential downsides and plan accordingly. They might use stop-loss orders in trading accounts, purchase insurance policies that protect significant assets, or structure their holdings in ways that shield personal wealth from business liabilities. They also maintain liquidity, holding cash reserves so they can weather unexpected downturns, meet margin calls if needed, or jump on discounted opportunities during market sell-offs. Legally, many also establish trusts, limited liability companies, or other vehicles to insulate personal assets from lawsuits or bankruptcies. These measures can sound sophisticated, but at their core, they reflect a commitment to ensuring that a single catastrophe won't derail decades of careful investing. Moreover, the wealthy treat each potential investment with the question, what's the worst that can happen, and how can I protect myself from it? If the downside is too great or can't be mitigated, they'll pass, no matter how appealing the upside may be. This blend of caution and optimism enables them to make aggressive moves in areas they know they can control, while sidestepping black swan events that could devastate less prepared investors. So, what lessons can we draw from how millionaires and billionaires invest? First, it all starts with a steadfast, curious mindset, one that prizes learning, welcomes calculated risk, and looks beyond fleeting market noise to identify enduring value. Second, patience is non-negotiable. If you're chasing immediate gratification or prone to panic selling, you'll struggle to harness the compounding effect that underpins so many fortunes. Third, diversification isn't just about safety. It's a way to capture growth from various sectors and soften the blow when one portion of your portfolio stumbles. Real estate can anchor your wealth with tangible value and recurring income, while startup investing introduces the thrill and risk of exponential returns. Networking, often undervalued by everyday investors, can expose you to exclusive deals and valuable mentorships, acting as a force multiplier for your financial endeavors. Additionally, striking a thoughtful balance between active and passive strategies can ensure you're protected during turbulent times while still positioned to profit from well-researched bets. Finally, never underestimate the importance of risk management. From insurance to legal structures, it's what keeps wealth intact through the inevitable market storms and life's uncertainties. And there you have it, an in-depth look into how the rich invest. Insider tips from millionaires and billionaires. If these insights resonated with you, consider putting them into practice step by step. Perhaps that means diversifying your portfolio a bit more, researching your first real estate deal, or simply committing to reading one investing book per month to sharpen your understanding of market dynamics. The journey to financial freedom isn't a sprint, but a marathon. And the strategies that billionaires use are grounded in principles available to anyone willing to learn and apply them. If you enjoyed this exploration of wealth-building wisdom, be sure to like this video, share your thoughts in the comments, and subscribe to stay updated on future content that empowers your financial growth. Thank you for watching, and remember, every great fortune starts as a vision and is built upon consistent, disciplined action. Take what you've learned today, chart your course, and step confidently toward your own version of financial success.